Investing is a powerful tool for building wealth over time. Understanding key concepts is the first step towards financial success. These concepts include evaluating risk. Potential investment returns are also important. Exploring diverse investment options is also necessary. Investing involves allocating capital into assets. The primary goal of investing is to increase value over time. Saving focuses on preserving capital. Investing is oriented towards generating growth. Investing seeks appreciation. Saving seeks security. Investment strategies often involve higher risk compared to saving. All investments inherently carry some level of risk. Higher potential returns are typically associated with higher levels of risk. Investors must understand their own risk tolerance. Risk tolerance assessment is crucial for selecting suitable investment options. Investment choices should align with an individual's capacity to handle potential losses. Common investment options include savings accounts, bonds, stocks, mutual funds, and ETFs. Each investment option has different advantages, risks, and investment time horizons. Diversification is a key strategy in investment management. Diversifying an investment portfolio can lower overall risk. Diversification also enhances the potential for portfolio growth over time. Effective investing is best achieved through a long-term perspective. Patience is a critical virtue in long-term investment strategies. Disciplined investment practices are essential for maximizing returns. Long-term investing allows individuals to fully leverage the power of compound growth. Consistent, long-term investment strategies are key to achieving financial goals. Compound interest is a method where earnings generate further earnings. This process accelerates the accumulation of wealth over time. The effect is similar to a snowball, growing larger as it rolls. This snowball effect significantly enhances long-term investment returns. Understanding compound interest is crucial for effective financial planning and investment strategies. Strategic asset allocation is a method of distributing investments across various asset classes. Common asset classes include stocks, bonds, and real estate. The primary goal is to balance investment risk and optimize potential returns. Allocation is determined by individual financial goals and investment time horizons. This strategy aims to create a portfolio aligned with long-term objectives. Inflation reduces the purchasing power of money over time. It is essential to invest in assets that can grow faster than the rate of inflation. This strategy helps to preserve or increase real wealth. Investments should aim to outpace inflation to maintain financial stability. Failing to account for inflation can erode the value of investments. Retirement planning starts with defining clear financial objectives for your post-employment life. A key step is estimating your future living expenses to understand the required retirement income. Developing an investment strategy is crucial for accumulating sufficient funds. The ultimate goal is to ensure a comfortable and financially secure retirement. Regular portfolio review is crucial for maintaining alignment with financial objectives. Adjustments ensure the portfolio reflects current risk tolerance levels. Changing market conditions necessitate periodic portfolio modifications. Reviewing involves assessing the performance of existing investments. Adjustment may include rebalancing asset allocations. The goal is to optimize returns while managing potential risks effectively.